Good evening. This is Milton Johnson, your financial coach. If you join me for the first time, either live or on my replay, definitely appreciate you for coming and joining in and helping with this live. Just want to tell a little bit about myself. I am a financial coach and I help small business owners and professionals, individuals design a financial blueprint to reduce debt, increase their savings and investments to achieve their financial and retirement goals through the use of my to retirement, roadmap to financial freedom methods. So definitely glad to have you aboard on this Saturday. I know people out there having fun with the family. Hopefully you're relaxing and enjoying the time off if you're off. You want to have balance and actually be able to enjoy, not just work all the time. So it's definitely a pleasure to have you on. And I'm going to be talking about something I think is great. A lot of people ask me about investing and what can they do to get started in investing. So I'm going to be talking about how to get started in investing, especially if you're a small investor. A lot of people don't actually have a large sum of money to get started. So this is actually a good time, and with the technology we have to actually get started in investing. And right now, with inflation at an all-time high, 40-year high, I mean, life is becoming more expensive than ever. The grocery stores, I mean, groceries are going higher. Gas prices just continue to go higher, jumped off the roof the last week or so. So the cost of living is going higher. And one way to actually keep up with some of the inflation or even beat the inflation is that you had to have your money invested in working for you. Having it in a savings account is just not enough. I mean, you may want to have some of your money in a savings account, but you don't want the bulk of it in there. I mean, earning 1-2% interest and inflation is in double digits, you'll actually be losing out on the buying power of your money. So you want your money to work for you. As a matter of fact, money loses value in a bank account. And a lot of people don't want to be working until they're 70-year olds. I know that some people are 70 and older that's still working. But if you get started in investing as soon as possible, and this is for my 20 and 30 some year olds, this is the right prime time for you to get started in investing. Because the earlier you start, the greater you can see a return and reap the rewards of the benefits. And it's even easier to start getting invested now, say with online investing. I know with myself, when I first started, I was looking at ways of actually how can I actually get into the stock market. I was very interested when I was younger, and I kept thinking, how can I make this happen? So I started doing some research, and there's one way you could actually start, which is using a full service brokerage firm. And this is where you actually sit down with a financial advisor and you give them basically your money. You tell them what your some of your risk tolerance, whether you're an aggressive investor, a moderate investor, whether you're very conservative, don't want to risk it. There's a risk reward there because greater the risk, usually the higher the reward can be. And if you don't want to really risk a whole lot, I mean, the reward or return usually is a little bit lower. So I was actually looking at some ways of how to get into this market. And after doing some research, I came across online brokerage firms in which I actually had to do it myself. And this is really was an opportunity for me to actually learn the stock market even more because I was able to do some research, um, make my own money, start off, you make your mistakes, you reap the rewards. And this is the time you actually get into the nitty gritty of really learning about investing. Now, that's just my opinion anyway. And so when you have little money, this is probably one of the best ways to go. This is where you go to a full service brokerage firm, in which I was a financial advisor. Usually you wanted people that had thousands of dollars to bring in, because financial advisors, your goal is to bring in assets, accumulate the assets, so you can make a commission off of those assets. So that was my job during that time. How many much money can I bring in assets either through rollovers or people having they had an inheritance or came into some money. How can I bring that into our brokerage firm? Put it into we do asset allocation, and then I would actually see my clients probably once or twice a year, and then to discuss how is everything looking. Do we may need to make any adjustments over time with their investment portfolio? So that would work for some people, especially if you have money. But what if you don't have any money? What if you have little money and you just want to get started, just get going? And that's where online brokerage firms could actually come into play. The one I started out was E-Trade. There are many more. You have TD Ameritrade, Fidelity, Charles Schwab. A favorite now, people like to do is Webull, Robinhood. So those are some of the ones that you can get into, and there's zero-based commission. Man, that's the difference. They used to be commissions, especially when I got started with E-Trade. I think it was $9.99 per trade. Now zero-based commission, and so it's making it even cheaper for you to actually get involved and start investing into these into the stock market. This is one thing you want to do is look at the stocks that you might want to buy. Actually gain some knowledge about the stocks, do some research on the different stocks that you may want to own, because once you buy them, you consider the owner. You own the share of that company. So you become a proud owner when you actually start investing into these stocks. And you can buy at fractional shares. That's a great thing. You don't have to actually buy a whole share. So there are discount brokerage companies that allow you to buy fractional shares. You just can put a certain amount of money per month just to buy, like I said, Amazon, Microsoft, Apple, GM, Procter and Gamble, Walmart, and those are some of the big favorites. You may have some others that you may have done some research on, and there's thousands of stocks out there that you may want to invest in. So make sure you're actually doing your due diligence, and looking at the right stocks to actually get into. And some people say, well, how much do I actually put in the stock market? Because we're always talking about diversification. You want to have some in the stock market. You may want to have some in fixed income. So the stocks, mutual funds, they actually invest in companies. And fixed income is more like the bonds or high yield CDs, which usually they're very stable. They don't make a whole lot of money, but usually the risk of it going belly up is very, very low. So you want to have a percentage of that in there. And as a rule of thumb, usually take your age and subtract it from 110. And this is usually the amount you should invest into the stock market. So for example, if you're 40, you subtract 140 from 110, that's 70. So this is what you would want to put 70% into the stock market, and the other 30% into something like bonds or the high yield CDs. That's just a ratio that you may want to look. That's just a base ratio to actually use to actually determine where you want to go. And then the ultimate decision is your risk tolerance. If you don't want to see your money go up and down in the stock market, you may want to put less in the stock market and more into fixed investments. And you might want to be careful about that. I'm reminded of a period. We just had the pandemic. And during the pandemic, the stock market took a big hit. As a matter of fact, it went down 40%. That's a big loss. And if you was about to retire, you probably was in a panic mode. But if you're a long-term investor and you sold, that was the wrong time to actually sell, because even though it went down 40% in 2020, the market came back up to an all-time high. So if you sold during that time, you sold at a loss and missed out on the market going back up. Usually when the market go down in such a dramatic fashion, usually I like to say, well, things are on sale. This is when you want to take advantage of things being at a low price and do a little bit of what we call dollar cost averaging. It would kind of like balance it out. So really, when you see the market going down like a dramatic fashion like this, and if you believe there's a good stock out there, a good company, you believe it's not going to go out of business or go bankrupt, this will be a good opportunity to actually invest some money in it. Because typically, it will rise back up and it will balance itself out. But you have to be patient. That's why it's good to have a professional with you, such as a financial advisor, a financial coach, kind of trying to coach you through these situations. Look at the different scenarios to try to help you make the best decision for you and your family. Because this actually is a great way to actually grow your retirement nest egg. And I talked before in some other videos, especially like getting an IRA. You can get a traditional or Roth IRA, and you can invest those in the stocks, mutual funds. You can invest those in ETFs, even bonds. So you may want to take a look at that. But you want to make sure that your portfolio is well diversified. And that's a key thing in owning different stocks. A well diversified portfolio is key. You don't want all of your stocks in one basket. Even though Apple is a good company, Amazon, you don't want to have all of your money tied up in one particular stock. You may want to have some Amazon, you may want to have some Microsoft, you may want to have some GM, some Walmart. So things that are diversified in case when it goes, one particular stock goes up and when the other one goes down, it kind of balances itself out. So you don't want all of it in one basket. And you want to invest only in businesses that you understand. Now, it's talking about if you don't really understand AI, which is at the beginning stages, and a company is invested in AI, you don't understand that company, why invest in it? And it'll be a good opportunity to actually learn about it before you invest in anything. So invest only in businesses that you understand. You want to avoid high volatility stocks until you really get the hang of investing. Because some volatility that can help. If you're a day trader, they love volatility because that's how they make their money. They make money with the stock going when it's down. They buy when it's down, then they sell when it's go high. Go back down, they buy it. Go high, they sell it. So unless you're a day trader or a swing trader, you want to get used to trading first before you start looking at high volatility stocks. Um, Another thing, a lot of people like to look at penny stocks. They're very cheap. So, oh man, I've seen some stocks for like sub penny. They're not even worth a penny, or they may be worth 2 or 3 cents. And penny stocks are very high risk. On a very few actually make money. So definitely, you may want to avoid those penny stocks. The majority of them are high, super risky. So unless you have money to put in there that you can actually afford to lose, I would not put in penny stocks unless you said, well, if I have like $500 and I lose that $500, it won't kill me. Then that may be something, but you don't want to put your whole portfolio. You have $100,000 and say, I'm going to put it all in penny stocks. Don't do that. Don't put it all in options neither. So you want to learn the basic metrics and concepts for evaluating stocks as well. Continue to learn the concept of diversification. You don't want to be too diversified, but you want to find the right diversification for your particular stocks. And then you said, well, I don't want to do that. And then let's say go to the mutual funds or the ETFs, in which a fund manager is actually buying those individual stocks in a basket and managing that for you. And you actually just paying them a fee for them to do that on your behalf. So that's not something that if you don't want to do all that studying, mutual fund or ETF can do that. And one of the big secrets is just continue to invest. One of our biggest overall investor is Warren Buffett. He's one of the best long-term investors ever. I used to question some of his judgment, but he found out to be great over the long term because he would buy certain stocks, good stocks, and just hold on to them for a long time. And he's done fantastic. Just if you don't know Warren Buffett, definitely look him up. Do some research on Warren Buffett and the way he approaches life. How he still do frugal things. If you look at him, you won't think this guy is a billionaire. All these billions and the way he lived, he still stay in the same house that he bought in the 1950s. He even drive himself to work. I saw him on a TV special. He was driving in a Lincoln. I said, what? But the people who really don't have money, they want to look like a big ball and shot caller, and they have a negative net worth. And he still stay in the same house since 1950s. And he multi-billionaire. One time I don't know what his net worth. I know it was around 100 billion at one time. So just think, if your net worth was 100 billion, if you had that much wealth, what would you be doing? But he's been able to retain his wealth and grow it over the long term. So just that may be some great principles of a great person you may want to emulate yourself from is Warren Buffett. Just take a look at him and show you how you could actually get started and hold stocks for the long term. Now, the one thing you might want to do, mutual fund. This is one thing I actually did when I first got started. I actually started buying a little bit per month. So like $50 per month to actually buy a mutual fund. And that's how I started off some long time ago. It started very small. And that's something you may consider if you don't have a lot of money or whatever you can afford. You may be able to afford $7,500 a month. But, get a good mutual fund. If you just get started in the stock market, then invest in the stock market. Just get started, find something good, continue to put money in there over the long term. Watch it grow. If you have some questions about it, definitely feel free to reach out to a professional, get a better understanding, because there's opportunities out there if you invest over the long term. If you're young, do it today. Get started as soon as possible. And if you're on Facebook, you could actually look at some of my groups. I have invested for the $50 a month challenge and the roadmap to financial freedom club. You're going to have a video in which I have someone explain if you were to put $100 a month at the age of 25, if you retire at 65, you'll have $1 million. And then if you just waited 10 years, 35, to invest, how that would be $300,000. But show the effect and power of compounding over the years. So the earlier you start, the greater you take advantage and opportunity of being able to compound over those years. So this is just some basic tips about how to get started with investing, whether you have some large sum of money or small amount. Usually most of the people I see one starting out investing have a small amount. So this is a good tip. Go back, look at the video, do some research on your own as well, because I want to see you successful. I want to see you grow. I want to see you take advantage of this market, not only for yourself, but for your family as well. They're looking for you to drive for success. But anyway, this is Milton Johnson bringing us to the end. I am your financial coach, and I look forward to talking to you again very, very soon.